Great to be here today to present to you all. As Ian said, I'm sure you're all familiar with Argo. Argo's obviously been around for a long period of time. It was founded in Adelaide in 1946, I think, so it's 72 years old. We recently had our 70th birthday. I'm sure a number of you are shareholders. We've got about 85,000 shareholders and about over $5 billion in listed Australian equities. That's the Argo, the listed investment company. I suppose for us, about 5 years ago, we saw, looking and talking to a number of our shareholders, and as sort of been alluded to by a number of people today, that a lot of Australian investors were overexposed to Australian equities. So we thought we'd look to provide an opportunity for investors to diversify outside of Australian equities. Not that there's anything wrong per se with Australian equities, but just thought you needed to have a little bit more diversification in your portfolio. So we looked, did a lot of research, sort of thinking what was the sort of product that we could offer to investors that wasn't available in the market, and we came up with global infrastructure. There's no other global listed infrastructure company, and we also thought a lot of the ethos of the sector in terms of being conservative and long-term in nature really fitted with suits the Argo style. So in 2015, we launched did an IPO of Argo Global Listed Infrastructure Company, or AGLI as we affectionately refer to it. My presentation today is really around the opportunity that we think that AGLI provides in terms of getting portfolio diversification particularly at a discount to what its NTA is. This slide's just the usual disclaimer that everyone's put up, so obviously it's all general in nature and not giving specific advice to anyone. I just thought I'd set the scene to start off just saying really what is infrastructure. I suppose you'd describe it as really long life, essential assets that are needed for society to function. But it really is probably a lot broader than what people actually generally think about. There's a number of sectors, and then within that a number of subsectors that I've got up here on the slide. Obviously within utilities, you've got electricity, gas, water, renewables, transport, things like toll roads, marine ports, railways and airports, communication assets, so that's things like wireless towers and satellite infrastructure. You've also got midstream energy, which is obviously things like pipelines, processing and also storage capacity. So it's much more than just utilities. There's different attributes to those different asset classes. Like some of them do have very much leverage to economic growth, like some of the transport assets. If you look at things like obviously railroads, they've been doing quite well with the economic strong growth in the US. Then you've got others that have got a particular thematic demand behind it, like something like communications in terms of the growing use for data use in terms of what that means for wireless transmission towers. Just talking about, I suppose, some of the characteristics of infrastructure, they are very much long life assets. There's obviously there's a lot of capital deployed to put these assets in place. Often they have inflation-linked pricing mechanisms, which gives you a hedge against inflation. Generally predictable, stable cash flows. These are often as a result of long-term agreements they might have in place or government regulation. You've also got quite high barriers to entry. A lot of the assets are quite monopolistic in nature. If you talk about things like airports, you might have some competing low-cost airports, but generally they're pretty powerful monopolies, a lot of these assets. Also things like tunnels, if you look at the Euro tunnel, you're not going to build another tunnel to sort of compete with that. And one of the probably key characteristics that sort of Ian mentioned is the really low correlation that infrastructure assets generally have, both with Australian equities and also with global equities. As well, these assets generally have a supportive regulatory framework in place. Generally, the demand for a lot of the assets, it can vary, but is fairly inelastic and resilient to economic cycles. Therefore, these assets tend to hold up a lot better during uncertain times. As Ian sort of alluded to, I mean, we're all quite familiar with probably the listed infrastructure space here in Australia, in terms of the well-known companies that we've got here in terms of Sydney Airport, Transurban. Australia was really probably at the vanguard of the listed infrastructure space. If you look, in terms of some of the privatisations that occurred 20 years ago, I mean, they're still very good. We think they're great companies, got great management teams. I suppose some of them are starting to get a little bit more mature. Still, some of them have still got good growth, but others are maybe just struggling a little bit and having to look in other ways to try and grow. If you look at also from a valuation perspective, even though some of the Australian infrastructure stocks actually yield quite well, if you look at other sort of valuation metrics, they actually some of them look quite expensive relative to other global infrastructure opportunities. In terms of the universe here, it's really about $94 billion in market cap, which is still sizable, but on a global scale, that's actually relatively quite small. In terms of what the global infrastructure space opens up is really a much larger universe for you that you've got available. There's over Cohen and Steers, who manages our portfolio, they've got about 350 companies available to them in their universe across 16 different countries, both developed and in emerging markets as well. There's about $2.4 trillion of market cap available for you to invest in. I mean, just to put that in perspective, that's about double the size of the whole Australian stock market. So there's all different types of assets, as I sort of alluded to within that. A lot of those you can't get access to here in Australia. I mean, it is definitely worth noting that the global infrastructure on average does have a lower yield than what you get in Australia. There's a number of reasons behind that. A lot of the way the Australian securities are structured in terms of how they pay out their cash flows. But we think a lot of the global things have actually got stronger sort of capital growth opportunities. I mean, some of the opportunities just of things that are out there, things like Union Pacific, which is a rail company in the US, Eurotunnel, Central Japan Railways, which they own the bullet trains in Japan. So it just sort of gives you an indication of some of the stocks that you've got available to you. In terms of some of the benefits of listed infrastructure relative to direct investments in infrastructure, transparency is probably a key one. Being exchange listed, you obviously get there's various disclosure requirements around the financial performance. Liquidity is obviously a big one. Being able to trade in and out of stocks if you're investing in direct infrastructure is really quite difficult for an individual investor. As I mentioned, the low correlation to broader equities, low volatility as well. That daily pricing that you've got as well with listed infrastructure. And as I've sort of mentioned, for a small amount of capital, you can get a good diversification opportunity. And another thing, particularly if you're investing in direct, is it often has a commitment period, whereas obviously where listed is you can decide to trade in and out of things as you choose. Just in terms of the outlook for infrastructure globally, we think it's still very positive. There's clearly increasing global demand. There's been historically a lot of underinvestment in infrastructure. I mean, you've only got to look at some of the tragic events that have been occurring around the globe with, bridge collapses in US and in Italy as well, toll roads. So there clearly has been, governments haven't necessarily had the balance sheets to be able to fund a lot of this necessary infrastructure. So you've seen a lot of privatisations occur, or you've seen a lot of privately funded infrastructure as well. Some of the other strong demand features for infrastructure are obviously clearly things like population growth, urbanisation, improving living standards in a lot of developing economies. Clearly people want to have a good standard of living. That means reducing things like congestion and that. It means putting in, networks, toll roads, etc. As I mentioned, it's obviously a good, it does have a lot of the assets have a good hedge against inflation. A lot of their revenues are protected with various mechanisms. For something like toll roads here in Australia have an inflation-linked pricing. So again, that gives some flexibility for the active managers to be able to trade between different different assets depending on their view of, the economic cycle and so forth. There's also growth opportunities, as I mentioned, around things like data usage for communications towers, also emerging markets. That growing middle class is a big opportunity there. It's also obviously worth being cognizant that there are risks in the sector as well. Obviously a big one that people sort of focus on is how does this sector perform in a rising interest rate environment. I think that's, you've got to probably look at what's the reason behind why interest rates are rising. If you've got obviously inflation and growth is occurring, as I said, a lot of companies have inflation protection, which does give you some hedge against rising interest rates. Others have, as I said, you can tilt the portfolio more towards those higher growth type of assets. I mean, undeniably, things that are more bond-like in nature will probably underperform in that environment of rising interest rates. Obviously, other things that, have to consider at the moment are things like trade wars. We've seen in the US, so you've seen actually port stocks have underperformed quite a bit, clearly because of the implication of tariffs and what that means for trade. But then you look at, as I mentioned, something like the railways have done very well with the strong growth that's occurred in the US. Something like Trump, he's obviously talked a lot about infrastructure, but he's delivered on a lot of things, despite whatever you might think of him. But he's probably done a good job, from business confidence, tax cuts, that's been positive. A lot of the infrastructure spend he's talked about, he probably hasn't been able to drive that. A lot of that occurs much more at a state level. So, but we still think there's a good, big opportunity there in the US and in a number of other economies over time. Another thing is things like regulation risk is another thing to consider, and that's where the really importance of an active manager comes in, to be able to mitigate all those different sort of risks that are out there. In terms of just moving on to Argo Global Listed Infrastructure specifically, this is just our objective, which is to really provide total return for long-term investors, which is both, it's a combination of dividend growth and capital growth, as well as from obviously a global listed infrastructure portfolio, which is providing diversification benefits for Australian investors. A little bit more on the details of AGLI, or ALI as its code is. As I mentioned, it listed in 2015. We manage, as in we, Argo Investments, manage the listed investment company, but the actual portfolio manager of the underlying assets is a group called Cohen & Steers, who's a very experienced infrastructure manager in the US. They are listed on the New York Stock Exchange. I'll go into a little bit more detail in them later. The vehicle is unhedged, so it obviously provides a benefit in terms of falling Australian dollar, obviously benefits the company. It's got no debt. We've currently got about 9,000 shareholders, and about half of those are self-managed super funds. As you can see there, the market cap's about $300 million. We've got a 1.2% management fee. That does decrease over time as we get the market cap hopefully up over $500 million. We've got no performance fee as well. Just at our we had our recent result, full year result. We had a record profit, and we actually paid our first fully franked dividend. But as I sort of noted, it's certainly not a high yielding stock. It's paying about a 2.5% yield, but that is fully franked. I suppose, as sort of Jeff alluded to, we want to get the dividend up and grow that dividend sustainably over time. So we're certainly not paying out dividends out of, in terms of unrealised profits and things like that. So we're trying to sustainably grow that further over time. In terms of the AGLI opportunity, as I mentioned, it really gives you that global diversification in one stock, which, as I mentioned, obviously the lack of diversification that a lot of Australian investors have at the moment. As I mentioned, the specialist global fund manager, Cohen & Steers, has got enormous global reach in terms of their analysts around the globe, number of experts in different regulatory fields and economists. They've got they've also got about $80 billion in funds under management. They've got good quality clients, so that gives you a lot of confidence as well. They're managing money for a lot of large institutions, also for sovereign wealth funds. And, it's really something that it's something that you can't really get access to as a retail investor before this in Australia. So that was really the appeal of Cohen & Steers for us. Got a proven track record of outperformance. 12 of the last 14 years, they've outperformed their benchmark. They get good access to opportunities as well, given their size. I think over the last 4 years, there's been about 50 IPOs in the infrastructure space. I mean, they obviously haven't participated in all of those, but they've had good access to a number of those, which have certainly, some of those have been beneficial. And as I mentioned, infrastructure tends to, it's enhanced really your risk-adjusted returns. It tends to be more defensive and less volatile in terms of the broader equity markets. And certainly, I think it tends to perform better than during periods of volatility. Some of the growth trends I'll talk about a little bit later. And I mean, the big real opportunity we see at the moment is the discount that it's trading to its NTA at the moment, which is about a 15% discount, which I'll go into a little bit more detail about that later. This just highlights the geographic diversification of AGLI as at the end of August. I mean, as you can see, it is about 55% in the US, but there is, within that, a lot of those funds, I mean, obviously the US is the largest capital market in the world. A number of those companies have got global assets as well within that. So we think it's quite diversified from a global perspective, despite looking like there's a lot there in the US. On a subsector basis, this shows again the mix of different asset classes than what their exposure to it is. I mean, it looks like electric utilities there's it's fairly large, 30%, but within that you've still got there's a lot of different utilities, and they all perform differently. Again, you've got things like transmission, then you've got retailers, generators. Different generators might be doing obviously renewables and so forth. So within that, there's quite a diversification in terms of the companies. And one of the key things, as I sort of mentioned, is there's a lot of different sectors there that we just can't really get exposure to in Australia, like things like water, communications and marine ports, for example. This is just showing the investment performance, the portfolio performance of AGLI since it listed. I mean, the first thing it's probably worth noting, I mean, particularly the last 3 years, infrastructure has underperformed global equities. There's clearly been a strong desire for growth assets, as in more the riskier high growth. Your tech sectors and things like that have done very well. I mean, infrastructure still performed positively, but not as well as global equities. Then this slide shows the 3 years of annual performance. Now, it's a little bit disappointing. Probably one of the rare years that Cohen & Steers did disappoint was the first year it did AGLI. And there's a number of sort of reasons. Was probably at the time it listed, they had the Greek debt crisis. Probably got a little bit wrong-footed there in terms of when to put money in the market. You also had currency was actually a bit of a headwind back there. So there's a little bit of initial underperformance in that first year was a bit disappointing. But since then, if you look now, particularly if you look on the column on the left-hand side, the last year and the last sort of 18 months, they've had really stellar performance, really, comprehensively beating their benchmark, and obviously benefited from the Australian dollar as well. So we're certainly happy in terms of how Cohen & Steers is performing, and as I said, they've got a very long track record of delivering. Just in terms of something that's a lot of focus for management and board of the company is the discount that the company trades to its NTA. Its last NTA I think was about 221, and its share price today might have been around 191. So that's about a 15% discount to NTA. I mean, as I said, I think this creates an opportunity for investors. I mean, as I said, you can really effectively buy a dollar's worth of assets for effectively 85 cents in the dollar. So we're certainly, I think part of it, as you see a bit more uncertainty in markets, we think that there may be a shift back to more some of these defensive type sectors. So we're positive in terms of the given the market conditions that may unveil over the next sort of couple of years, that infrastructure should do well through that environment. But we're certainly trying to be proactive through a number of initiatives to try and reduce that discount. We've undertaken an on-market buyback since April in 2018, so we've bought back about $1.7 million, which is about 1.1% of the issued capital. This obviously improves the value of the remaining shares. There's also the dividend reinvestment plan. Unlike a lot of other companies that probably issue new shares, we've actually been, those shares, we've been buying them on market existing shares, so not to further dilute the company's NTA. We've put a lot more focus into marketing and communications. We've recently hired Meredith Hemsley, who's up the back there, so she's outside. We'll both be outside at the table and happy to have discussions with anyone outside. So we're certainly being proactive on this. We don't think there's maybe it was a little bit of initial, that underperformance and just as an asset class, but we're still very confident on the long-term outlook for it and confidence in the manager's ability to deliver on performance. The last sort of 6 months or so, it's actually probably been one of the better performing stocks from an NTA perspective. It's actually closed up a bit of that gap as well on the discount. I mean, it was actually greater than that, but still we've got a lot more work to do. We've been getting some new shareholders on board. As Jeff was saying, you shouldn't buy a stock at a 20% premium. Jeff's actually been buying this stock as well. So there you go. That's a vote of confidence in AGLI for you. In terms of in terms of investor engagement, I won't go into a lot of detail here, but this is really a lot of this, similar for a lot of companies. But if you really want more information, you can find a lot of information on our website, which is argoinfrastructure.com.au. There's independent research there, weekly NTA and investment updates, a lot of quarterly reports, presentations, videos. Cohen and Steers, the manager, will do quite a few, put a lot of research on there as well. So if you're looking for more information, the website's a great source to go to. In terms of the top 5 holdings, these that you may not be familiar with is number 1 holding is actually a company called NextEra Energy, which is a utility in the US. It's called Florida Light and Power. They've got about 5 million customers, and I know you think, utility a bit boring and defensive and that, which it does have that attribute, but it's actually had very strong growth as well. Florida is a really strong growing part of the economy in the US from a population perspective, so they've been really expanding their network, as well as they're also the largest solar and wind power generator in the US. I mean, despite concerns about Trump may not, pro-coal and things, energy policy is very much still driven at a state level, and a lot of the states within the US have been pretty strongly supportive of renewables. Another company is Enbridge. That's a Canadian midstream energy company. They own mostly North American oil and gas pipelines and storage. They also own wind, solar and geothermal energy projects. Another company is Crown Castle, which they own wireless communication towers, so they transmit all your wireless signals and data. I'll actually discuss that a little more in the next slide. American Tower is a similar company in terms of owning wireless communications tower, but despite its name, is actually a much more global company. It's got a lot of global wireless infrastructure in places like Europe, Asia and Africa. And the other one was just mentioned there, top 5, is Union Pacific, which is a railway company and has extensive US network. The portfolio's got about 50, 60 holdings in all, across a spectrum of infrastructure assets, often large companies with strong balance sheets and growth opportunities. Just one stock in focus quickly was Crown Castle, and as Bill sort of alluded to in his presentation, is that really strong thematic of global data usage. I mean, this is the largest wireless transmission tower operator in the US with more than 40,000 towers. It's listed on the New York Stock Exchange with a market cap of $32 billion. It's a bit like a rooftop property trust which leases out their space to communication towers to mobile carriers and government agencies, high barriers to entry and great leverage to increasing data traffic. They've also got fibre optic cable and, you know, also small cells for really that more intensive connectivity at places like stadiums. Some of those growth drivers for this, as I said, that multiple devices for people, you know, ultra high definition video usage, Internet of Things, you know, driverless cars. I mean, the amount of data that's, I saw a stat the other day was amazing, that a driverless car will, in 1.5 hours, will use as much data as what 1,000 mobile phone users will use in a month. So that just gives you an indication. Look, it's still some way to come yet in terms of that, but the incredible growth that's going to come over time in requirements for data. And, you know, Crown Castle's a large incumbent, and the other thing obviously is that 5G technology, which was alluded to earlier as well today. So we think they're really well leveraged to that thematic. Just sort of finishing off, just a couple of thoughts to sort of leave you with. You know, I mean, again, you've seen the last few days, global markets have been getting a bit jittery. I mean, they've had a great run. I mean, infrastructure's actually underperformed quite a bit. Sort of, if you're getting nervous, I mean, infrastructure's actually is a great, really defensive asset class. I mean, it's interesting if you look even over the last few days. I mean, though people go, oh, how's this going to perform in a high interest rate, a rising interest rate environment? I mean, infrastructure's actually done relatively well over the short time period. Again, it's a lot of those high PE stocks that had a phenomenal run. They're the ones that have been coming down again on concerns of rising rates and, you know, trade issues. So we think AGLI is a great opportunity to bolt on diversification at a 15% discount, and it's run by a quality manager. So we think it's really a compelling opportunity currently. We've got Cohen & Steers is coming out. We've got a roadshow occurring later this month in October. If you'd like to find out details on dates, you can find it on the website or outside. So that's you know, great opportunity if you want to get some more detail, or myself and Meredith will be outside and we're happy to take any questions. Thanks very much for your time. Yeah.